Good morning everyone. So today we'll quickly revise Ind AS 110, that is consolidated financial statements, and we'll take up some good questions so that you are thoroughly prepared for the examination. Before we begin, can you just confirm me if the screen is visible and if my audio is clear, or if you want to increase the volume, you can just let me know. I'll increase the volume accordingly. Okay, so we are good to go. Now this is a pure examination oriented revision, so I'll not be going into too much of logics and things. What I'll be telling you is how to approach a question in the examination, what are the things you should take care of, and some complex adjustments, including the questions which are asked in the a couple of attempts earlier, which were actually good. And one more thing that you have to keep in mind, because now it is 14-mark question, we don't expect a very lengthy question to be asked in the examination. So to begin with, in a consolidation question from Ind AS 110, there are two parts to it. One is the theory part. Theory part, you can just do a couple of revision towards the end. No need to break your head on theory part. Just understand the concepts of control, power over investee, and all of that. This will be mostly tested for 2 to 4 marks, not more than that. Most important is the practical question. Now when it comes to practical question in the examination, the structure is very simple and predictable. So you will have a company which is a parent, you will have a subsidiary, right? Now in this parent and subsidiary, the question will tell you parent has some percentage stake in subsidiary, or they will tell you the parent has so many shares in the subsidiary, and accordingly you have to calculate what is the controlling interest and what is the non-controlling interest. Okay, so here they have influence, they have power to appoint board of directors. All of these are generally not asked. What they will directly tell you is parent has, let us say, 60% stake in subsidiary. So from that we can directly start our answer. That is the first thing. And a lot of times we are asked question based on step acquisition. Already there is some investment and the company has acquired additional investment, right? So that is the broad structure of the question. You will have balance sheet of parent, you will have balance sheet of subsidiary, and there are some adjustment. These adjustments is what you should focus on. Once you are thorough with the adjustment, consolidation as a question is not at all a challenge. And let me tell you, out of 14 marks, you can easily score 10 to 12 marks even if you make a couple of mistakes. Even in that case, you can easily score 10 to 12 marks because there are marks for balance sheet, there are marks for notes to accounts or the working notes, there are marks for goodwill calculation. So because it is a stepwise question, even if it is a difficult question, or even if they give sometimes a confusing question like they are given in Nov'23, even then you will be able to manage and get the marks. Is this class useful at CA inter level? Somewhat it is related, but not 100% related. There are some differences, so you should not get confused. Now coming to handling the questions in the examination, first you should focus on the basic consolidation process. Now what is this basic consolidation process? The steps that you should be following in a sequential manner so that you get the right answer. Now I have listed down some steps. You may have learned in a different order, that is also perfectly fine, but what you have to keep in mind is all these steps you do or you complete in the examination. Now the first step, what I generally prefer, is calculation of goodwill and capital reserve on date of acquisition. This is based on your principles of Ind AS 103. Whatever you have learned, that you will apply the same principles and you will get it done here. Now as far as Ind AS 103, or as far as the first step is concerned, this is on the date of acquisition. So you should know what is the date of acquisition. Is it the first date of investment, or is it the date of investment when we obtain control? It is always the date of investment when we obtain control. So calculation of goodwill and capital reserve on the date of acquisition, that is when you have obtained control over the entity. Sir, how will we know this date? This date will be given to you in the question. Now when you calculate goodwill or capital reserve, first you will take fair value of the purchase consideration, that is the fair value of purchase consideration, assets that you have given, cash you have given, then any other liability you have incurred, all of that which is a purchase consideration as per Ind AS 103 you will consider. This number directly generally is given as investment in subsidiary. They will directly give you in the question that we have acquired the subsidiary for this amount. So here also I don't expect a very complex calculation when it comes to calculation of purchase consideration. So that is the first thing. Second thing is fair value of existing stake. Now this is where it is important when you have a step acquisition. Let us say currently we hold 20% stake, then we acquired 40% stake. This 20% stake was at a cost of 1 lakh. 40% stake we acquired at a cost of 5 lakhs. This was, let us say, on 1st of January of year 1. This is, let us say, on 1st of January of year 5. Now this 5 lakhs is the stake that we have acquired in the current transaction when we obtained the control. What Ind AS 103 also requires us to do is, this thing we have to do a fair valuation. On which date? Fair valuation on the date we have obtained control. So what is the fair value? Either this fair value will be given to you in the question, or for 40% we paid 5 lakhs, for 20% it will be how much? 2,50,000. Like this also you can calculate. Or based on NCI, sometimes they will give you non-controlling interest fair value. Based on that also you can calculate. Sometimes they will give you per share value. Using the per share value also you can calculate. So this thing is the fair value of existing stake. When we calculate, we have to see what is the value on the date we have obtained control. Then NCI on the date of acquisition, this we can do based on fair value or on the basis of net asset, depending on what is given to you in the question. If fair value information, if the question does not say anything, then we generally follow the net asset method. If the question says fair value of NCI is so much, we will take the NCI fair value, right? Then the total of these three will mark it as A. The next thing is, what is the fair value of identifiable net assets on the date of acquisition or on the date on which we have obtained the control? That is fair value of identifiable net asset. So how to calculate this? Now this you can calculate either as fair value of assets minus fair value of liabilities. This is very rare. Okay, in the examination they will not ask us to calculate fair value of assets and fair value of liabilities in 99% of cases when the question is on consolidation. If it is a question on Ind AS 103, then this approach can be applied. In other cases, you will take the share capital, reserves on date of acquisition and any fair value adjustment. This will cover in step 2. So, whatever is the share capital, reserves on date of acquisition, and we will do some fair value adjustment to arrive at identifiable net assets on the date of acquisition. So, coming to step 2, we take share capital on date of consolidation and date of acquisition, retained earnings on date of consolidation and date of acquisition, other equity, all the items. What is the value on date of consolidation? This is the balance sheet date on the date of acquisition on which we have obtained the control. Now, I have put some hypothetical numbers here for understanding. 4,000 share capital, nothing is post acquisition. Retained earning was 2,000 on balance sheet date, 1,000 on date of acquisition. The difference we can directly say is post acquisition profit. Of course, if there is a mid-year acquisition, we have to do some more adjustment, that will come to it subsequently. Then other equity on date of consolidation in the balance sheet is given as 1,000. On date of acquisition was 0, then entire 1,000 becomes post acquisition. Right? Now this is standard. This date of acquisition, this will be given to you in the question, that on the date of acquisition the retained earnings was so much, the general reserve is so much, other equity is so much. What is the thing that we have to keep in mind is these fair value adjustment, and here is where a lot of students make mistakes. See, this date of acquisition number which is given in the question, that is as per the book values, but as per this step we have to take fair value of identifiable net asset. So there is a possibility that the net assets have a different fair value than what is captured by the subsidiary. So in that case, what we have to do, in that case we have to take fair value adjustment. Now sir, what is this fair value adjustment? Say for example, The plant and machinery in the books is at 1000. Fair value is 1500. This is the carrying amount. This is the fair value. Then in that case, what we have to do? This 1500 fair value is what we should consider while calculating net assets. But in the books, it is only captured at 1000. So the difference of 500 is what we refer to as fair value adjustment. This will be given during the question. You have to carefully read the question and take the numbers. So here in this example, what I have considered is fair value adjustment is 500. Means the book value of the asset is, let us say, 1000 and fair value is 1500. Only the difference amount we will take here. So on the date of acquisition 500, on the date of consolidation also 500. Now here one thing you have to keep in mind, if there is something like inventory, okay, if instead of property, plant and equipment, if this is something like inventory, that inventory if you have sold off, then on the date of consolidation you will see what is the exact number. If it is PPE, we would not have sold it, so we will continue to show it at the same number. So that is on the date of acquisition. So it's 500, 4000, 1500, all of this put together makes your identifiable net assets on date of acquisition. Identifiable net assets on date of acquisition. Now whenever there is a fair value adjustment, the next thing that should strike your mind is additional depreciation or savings in depreciation. Now in our example, assets have gone up by 500. If assets have gone up by 500, the depreciation should also increase subsequently. So you have to calculate what is the depreciation on fair value adjustment subsequently. What is the depreciation on fair value adjustment subsequently? So how to do that? Either they will give you a rate or you have to take the useful life and calculate the depreciation. Now this is not for 1 year. This depreciation on fair value adjustment is from the date of acquisition or control till date of consolidation. So from date of acquisition till date of consolidation, what is the depreciation? What is the additional depreciation you should charge? That is given. That is what we will capture here. So that forms part of your date of consolidation date, and this 50 of additional depreciation is entirely your post acquisition profit. I have increased the value of assets, there will be additional depreciation. That additional depreciation will reduce my post acquisition profit. Then if at all there are any unrealized profit when subsidiary sells the goods to the parent, that also will adjust on the date of consolidation. Right now, as far as goodwill calculation is concerned, we will take equity, share capital, retained earnings, other equity, all of that, fair value adjustment, this total of 5500, we will plot it here. So if the total of purchase consideration, fair value of existing stake, NCI on date of acquisition, if that is more than the net asset, the difference is goodwill. And if the net assets are less, then it becomes capital reserve. Now here the standard makes it very clear that if at all there is a bargain purchase or capital reserve, please go back and recheck your fair values, because generally transactions happen at fair value. So there is a very rare chance that you will have a capital reserve. But yes, if in the question it is a capital reserve, you will take it as a capital reserve. So first step is done, calculation of goodwill. Second step we have done partly, that is analysis of reserves and calculating the net assets on the date of acquisition. Okay, so after this, what we need to compare is the difference between date of consolidation and date of acquisition is your post acquisition profit. So retained earnings movement, on here it was 2000, on date of acquisition is 1000, this 1000 becomes post acquisition. Other equity 1000, 1000 becomes post acquisition. Any depreciation adjustment is post acquisition. Any unrealized profit is post acquisition. This post acquisition profit will be split between the non-controlling interest and the parent. It will be split between the non-controlling interest and the parent. Right now here mid-year acquisition can be a problem. So if there is any mid-year acquisition, let us say retained earnings on 1st of April of year 1 is 1000. Retained earnings on 31st of March of year 2 is, let us say, 2000. Right, and acquisition date is 1st of October of year 1. Now in this case what we will do is 1000 to 2000, the difference between these two, this 1000 is profit for year 1, year 2. This is the profit for year 1, year 2. Out of this, we'll assume 500, half is pre-acquisition and balance 500 is post-acquisition. This time adjustment is very important whenever there is a mid-year acquisition. If you have any confusion here, please mark this adjustment, because most of the times this adjustment will be tested in the examination, right? So then 1000 plus 500, my pre-acquisition becomes 1500 and my post-acquisition becomes 500. Now here, a lot of time Institute adds one more adjustment, that is dividend. The company has declared dividend out of pre-acquisition profit. Let us say in this case they have declared dividend of 300. They have declared dividend of 300 out of pre-acquisition profit. Then what happens? On 1st of April, my balance was 1000. On 31st of March, my balance was 2000. Now out of this, they have declared and accounted for the dividend of, let us say, 300. So my opening balance now becomes 700, closing balance becomes 2000. So what is my during the year earning? 1300 is the profit for the year. Out of this, 650 pre-acquisition, 650 post-acquisition. This is a very important adjustment when dividend is declared out of the pre-acquisition profit, and you have to do this particular adjustment, right? Then this, if you get confused, if you are preparing a statement format, you can draw up a ledger, retain earnings by balance brought down 1000. Then they have declared dividend, so to dividend 300, to balance carried down 2000. So 2000 plus 300 minus 1000, profit during the year is 1300. Out of this, 650 is pre-acquisition, 650 is post-acquisition. This is one adjustment. Mark it as very important. Mark it as very important. And what you also need to do is practice. This has been tested in the previous attempts also. Practice it so that you don't miss it out in the examination. Thank you, sir. Because of your classes and guidance, I cleared my CFL exams. Thanks, Kusuma. Sir, can I watch this for first time if I have not done and my exam in Nov'24? You can do it, because consolidation as a chapter is very important. You should not leave this chapter. Watch this video and practice the questions which are given in my material class solutions. You can download it and practice the November 23 question and May 24 question. That will help you. Financial instrument brush up concepts, yes, that also will be coming up very soon. Okay, so don't worry about that. Right, so this is the thing about consolidation, pre-acquisition, dividend and adjustment. Okay, so after we have done this net acquisition, net assets on date of acquisition, the next thing is the non-controlling interest. For non-controlling interest, you will take opening balance on date of acquisition. So from where will we get this? From this portion. Date of acquisition total is 5500. Out of that, in this example, 20% is non-controlling interest. So 1100 will be taken to your non-controlling interest opening balance. Then from post-acquisition, whatever is their share will add to post-acquisition reserve. How do we get that? From this post-acquisition column, whatever is belonging to the non-controlling interest, 20%, that we will add there. Now, sir, I don't want to prepare this table. See, this table is the thing where they have given a lot of information. If it is straightforward, without preparing the table also, if you want to do, you can definitely do it, but don't miss it. So, non-controlling interest, balance on date of acquisition, post-acquisition reserve, and if impairment of goodwill is there, this you have to remember. If we are following NCI at fair value, then goodwill impairment will be shared between parent and NCI. If we are doing non-controlling interest as proportionate of net asset method, then only parent will take the goodwill. This is very important for you to remember from examination point of view. If it is fair value, this goodwill is full goodwill, and when it is full goodwill, both NCI and parent will take it. If it is part goodwill, that is proportionate of net asset method, only parent will bear the impairment of goodwill. We will do one question on impairment of goodwill, a very beautiful question from RTP, Ishwar and Vinayak. That if you do it thoroughly, it is done. Okay, there is no problem at all if you are able to handle that question. Okay, then after this, the next thing is consolidated retained earnings or reserves. Now here you will take 100% of the parent shares of post acquisition profit from this working note. So here whatever is the total from parent you will take it, then parent shares of impairment of goodwill, this you will do, plus if there is any unrealized profit from parent to subsidiary, that you will adjust here. Okay, now preparing of consolidated balance sheet, I think you all are champions by now. How do you prepare that? Take 100% of parent, 100% of subsidiary, and very important, adjustment of fair values. Whatever fair value adjustments are there in this particular section, that you have to consider. One tip that I can give you is, all the adjustments that you do as working notes should have some impact on the balance sheet, and you should do the impact at two places. If you remember this, your work is very easy. For example, depreciation on fair value adjustment, this number, depreciation on fair value adjustment. Now this one adjustment is post acquisition profit, second adjustment is reduce it from the PPE. So once you do this, there is no problem at all. There is no problem at all as far as the computation or preparation of balance sheet is concerned. Okay, so coming to the balance sheet, 100% of parent, 100% of subsidiary plus fair value adjustment. Liabilities 100%. Intercompany balances eliminate. So if, for example, if there is a trade receivable, trade payable, remove from trade receivable, remove from trade payable. Share capital, you will take only parent. Reserves, what you have calculated as per step 4, that is parent plus share in subsidiary. Okay, now as far as share in subsidiary is concerned, if you want to split between retained earnings, other equity, you can do that. NCI as per working note, investment in subsidiary you will no longer show. Unrealized profit we will reduce from inventory or the asset and from the P&L. Impairment of goodwill you will reduce from the goodwill and consolidated reserves. NCI if it is fair value. So far is it clear? Any questions so far? Okay, no questions? Great. Now, after we are done with this, few things that we have to keep in mind, and I'll quickly revise, and then we'll move to some questions, critical questions which you can which can help you in the examination. First is intra-group balances, means balances between parent and subsidiary. Let us say parent, there is a trade payable, for subsidiary there is a trade receivable. This you have to knock it off. So if there is any intra-group balances, trade receivable, trade payable, investment in debentures, investment or debentures issued, whatever is there, you will reduce from both assets and liabilities. So basically, from asset also you will reduce, from liability also you will reduce. If parent has receivable, subsidiary has payable, in the consolidated balance sheet reduce both receivable and payable. So one critical adjustment here is bills payable and bills receivable. If this bills receivable is discounted with a bank, the amount that is discounted with the bank is not deducted from bills payable and bills receivable, because that amount is now payable to the bank. Whatever is there within the group, only that you will reduce. That is the first thing. This is mostly asked in almost all the questions. Unrealized profit on sale of inventory and sometimes PPE also. Now when there is an unrealized profit on sale of PPE, a lot of students are confused, like, sir, where should we reduce from, subsidiary or parent, or which should NCI bear the share and all of that? Simple technique. Simple technique is, first ask the question, who sold the inventory? Who sold the inventory? If parent sold to the subsidiary, reduce it from the parent's reserves. If subsidiary sold to the parent, reduce from the subsidiary reserves. So if subsidiary sold to the parent, we call it upstream, then you will reduce it from post acquisition of subsidiary. When you reduce it from post acquisition of subsidiary, automatically NCI and parents are taken care of. Automatically NCI and parents are taken care of. And if it is from parent to subsidiary, then you will reduce it from the consolidated reserves. Only parent will take the hit. So what is the second impact? Second impact is reduce from inventory. Then if it is a sale of non-current asset, very important, if it is a sale of non-current asset like property, plant and equipment or any other fixed asset, then in that case what happens? You have to carry out the depreciation adjustment. Now who should carry out the depreciation adjustment? If parent has purchased, if parent has purchased means parent has now charged, let us say, higher depreciation, then you will adjust in parent. So here depreciation adjustment will be done by the purchaser. Depreciation adjustment will be done by the purchaser. The profit adjustment will be done by the seller. Profit adjustment will be done by the seller. Depreciation adjustment will be done by the purchaser. Unrealized profit on assets is eliminated.
It's 10:30.
Compute unrealized profit from the point of view of the selling company. So don't need to confused about downstream, upstream and all of that. Point of view of the selling company. In case of non-current assets, buying entity would have charged depreciation considering the purchase price. The depreciation computation should also be adjusted. So for example, profit is 2000. We have sold PPE. On this 2000 there is extra depreciation. That extra depreciation we have to reverse. Then very important, fair value adjustment on date of acquisition. So the reserves in all, the number that would be given to you would be as per the book value. Then what you would do, you will take fair value of assets and liabilities on date of acquisition to calculate the net assets on date of acquisition. When you do this, you will increase or decrease the fair value as fair value. Subsequently, you will also check the depreciation and all on that fair value adjustment. That is the first thing. Second most important thing is the subsidiary, because it continues to prepare financial as statements based on original carrying amount. On date of consolidation also you have to do fair value adjustment. That is why in my working here, if you see, I have fair value adjustment both on date of consolidation and date of acquisition. Just because it is done on date of acquisition, don't ignore it on the date of consolidation. Then the next important thing here is deferred tax. If tax rate is given on this fair value adjustment, there will be a deferred tax consequence. So if asset value increases, there will be a deferred tax liability. If asset value decreases, there will be a deferred tax asset. Okay, so that you have to consider, considering the tax rate if it is given in the question. Now sometimes institute is very smart. Initially they will say tax rate is so much, and subsequently they will say that it doesn't have any deferred tax impact. In that case, you will not take the deferred tax impact. Then if there is a bonus issue, this particular component, if there is a bonus issue, we will assume it is out of pre-acquisition. That is how the question has been asked so far. And if it is from pre-acquisition, simply what you can do is you will reduce it from retained earnings and you will add it to the share capital. Calculation of goodwill or capital reserve is not impacted because of bonus issue on the date of acquisition. Okay, so or you can make a note saying that because there is no impact of bonus issue on the goodwill or capital reserve calculation on date of acquisition, no adjustment has to be done. That note can be given, or you can simply increase the share capital, reduce the retained earnings and do the calculation. The impact will be the same. Okay, sir, what if they give out of post acquisition? If at all they do that, then what you have to do is from this retained earnings balance, once you get to the calculation of retained earnings balance, part of it you move it to capital reserve. Part of it you move it to capital reserve, but don't change this date of acquisition calculation. Don't change the date of acquisition calculation. Only in the post acquisition you will do this movement. I showed it here. It is not right here. From retained earnings you will move to a separate column called capital reserve. Now what we'll do is we'll take up a couple of questions quickly, and then again we will come back to the discussion. Look at this question. So once we solve this question, you will have a good comfort on how to handle questions on consolidation. Summarize balance sheet of PN and SR as on 31st March 2018 were given below. Amount is given. So they have given, land and building, plant and machinery, investment in SR Limited. So this is what is your purchase consideration. Then inventory, trade receivable, cash, total assets, equity, all of these are common. Shares of rupees 100 each fully paid. So here you can see 6240 and that is the number of shares. Other reserves, retained earnings, trade payable, short term and all of that. Okay. PN Limited acquired 70% equity shares of rupees 100 each in SR on 1st of October of 17. So this is a immediate acquisition, first thing. Okay. Then the retained earnings of SR Limited showed a credit balance on 1st of April 17, 93,600, out of which a dividend of 12% was paid on 15 December. So this is a typical adjustment that you will get in almost every alternate questions in the examination. This is the opening balance 93,600. From this, dividend of 12% is paid. 12% of what? 12% of 6,24,000. So 12%. of 624, that is 74,880. That is the dividend paid. Okay. PN Limited credited the dividend received to its retained earnings. This is absolutely right. This is absolutely correct. Don't get confused or don't bring your CA intermediate concept here. It's a pre-acquisition, so we have to reduce the cost of investment. That is as per what you do when you do AS 14, AS 13 principles or apply AS 21. Here, it is taken to retained earnings is absolutely right. Now, some of you have doubt. Sir, this 93,600 total dividend that is paid, 74,880 total dividend that is paid, out of that, there is a part of it which is intercompany. Should we not adjust that? See, even if you adjust that, what you will do? You will reduce from the retained earnings of parent, you will add it to retained earnings of subsidiary, total ultimate impact will be the same. So, this 12%, this dividend declaration is relevant for us only to calculate pre-acquisition and post-acquisition profit. Other than that, no need to break your head on any other adjustment. Then, fair value of plant and machinery of SR Limited was 6,24,000. The rate of depreciation is 10% per annum. On 1st of October, it is 624. So, what we will do? We will see 624. That is the fair value. And here, they have given plant and machinery 4,21,200. This is on which date? 31st March of 2018. So, how to calculate? So, this you will back work. You will back work and see what is the value on 1st of October. And with that 1st of October valuation, you will compare 624. And the difference will be fair value adjustment. Difference will be fair value adjustment. Mark it as a very important adjustment. Especially, you have to do a back working. Following are the increase and comparison of fair value as per respective Ind AS with book value as on 1st of October of SR Limited. Land and building 3,12,000. What is this? Increase 3,12,000. Inventory is 46,800. Trade payable 31,200. So this also is an increase. Inventory is still unsold on the balance sheet date. Now why is this given to us? See, this inventory is unsold on the balance sheet date. It is given to us because if you remember, I said on date of consolidation also you have to see what is the fair value impact. If this inventory is unsold, the fair value impact still remains there. So what if the inventory is sold? Then to the extent of inventory, for example, if this inventory is sold, then the fair value adjustment on date of consolidation for this 46,800 will become 0. Okay. Other reserves on 31st March are the same as on 1st of April. So other reserves also there is no change. The business activities of both the company are not seasonal in nature and therefore it can be assumed that profits are earned evenly throughout the period. Prepare consolidated balance sheet on 31st March for the group of entities PN and SR as per Ind AS 15 marks question. Now this can also be given as a 14 marks question. In the current examination, they will remove one or two adjustments. This covers broadly all the adjustments that are generally tested in the examination. Okay. Now here, first is what is the date of acquisition? 1st of October. What is our stake? 70%. This is there in the question. This, even if you don't write in the examination, you will not lose marks. Now, the most important thing is pre and post acquisition profits of SR. How to calculate? See, one is you can prepare a ledger or you can do an adjustment like this. On 1st of April, 93,600 is the retained earnings. That is what they have given in the question. Then dividend we calculated 74,880. So difference of these two, opening balance becomes 18,720. Closing balance is 25,800 on 31st of March. So from here till here, how much did we earn? 2,37,080. The other way to do this is you can prepare a table like 1st of April, the balance is 93,600. On 31st of March, the balance is 255,800. From this, we pay dividend of 74,880. Okay, so this balance is now 18,720. Here the balance is 255,800. The difference is profit. Now, for pre-acquisition, what you will do? Out of this profit, you will divide into two parts, 50-50. 1,18,540 plus 18,720 becomes my pre-acquisition. And balance becomes post-acquisition. Or you can prepare a retained earnings like this to calculate what is the profit and loss earned for the period. This is much simpler. Huh? This is slightly lengthy and complicated. This is more simpler. Now, how to calculate net assets of SR Limited on 1st of October? Equity share capital 624. Other reserves 3,12,000. Because the question said other reserves have not changed. So from the question itself we can take 3,12,000, the same number. Then retained earnings and add pre-acquisition profit. This will be your retained earnings pre-acquisition. So this is the total net asset. Now the same thing, if you want, what you can do is, this is on date of acquisition. You can have your date of consolidation 624,000, 3,12,000. This has not changed. Then 255,800, 255,800, right? 255,800. So this will give you post acquisition. 0 here, 0 here. The difference between 255,800 and 118 and 93,600. 255,800 plus minus 118,540 minus 93,600, you get 43,660. 43,660. Okay, so there is dividend also paid. I missed this part. 74,880 of dividend is paid. So plus 74,880 dividend that has been paid. 1,18,540. 1,18,540. Then adjustment of fair value is very, very important. Land and building, inventory, trade payables, plant and machinery. This is very, very important that you have to calculate. How do we calculate? See, carrying amount on 31st March is 4,21,200. Now, this is the opening balance minus 10% depreciation. So, how much will be the opening balance? 4,21,200 divided by 90%. Why 90%? See, if it is 100%, how much will be 90%? So, 421,200 is 90%. If you divide by that, you get 100%. So, 468 is the opening balance. Then 5% depreciation for 6 months is 23,400. So, carrying amount on 1st of October is 4,44,600. Fair value is 6,24,000. Increase is 1,79,400. So, 1,79,400 increase here. Land and building, inventory, trade payables is given in the question. So, increase in net assets is 5,07,000. So, the total fair value will become 11,48,000 plus net assets increase in fair value 16,55,140. Out of this, NCI is 4,96,542. 4,96,542. This is total fair value. This is NCI. This 1655 you will take it to calculation of goodwill. So fair value of consideration, value of NCI is already we have calculated. So this becomes the total. Net assets is so much. Goodwill is 89,402. Okay. Now there is an increase in plant and machinery value. Land and buildings, there is an increase. Inventory there is an increase, trade payable there is an increase. Inventory, it is unsold. Land and building, they have not given a breakup. They have just said land and building is 3,12,000, so they have not given a breakup of that. So only depreciation will be on your plant and machinery. So on plant and machinery, the fair value on 1st of October is 624. Depreciation for 6 months is 31,200. Carrying amount is 5,92,800. So incremental depreciation is your 31,200 minus 23,400, 7,200, and net increase in fair value is 171,600. This is a very critical adjustment that you have to be careful about. So basically what we have done, 6,24,000 is the fair value on 1st of October. Depreciation for at 10% for 6 months is 31,200. So my carrying amount should be 5,92,800. Okay. And what is the carrying amount as per the balance sheet? As per their balance sheet, the carrying amount is 421,200. So $421,200 minus 592, 171,600 is the net increase in fair value. Net increase in the fair value. And additional depreciation, the difference between these two, 7,800. Then post-acquisition profit of subsidiaries, 1,18,540 we have already calculated. Additional depreciation 7,800. So this is for the consolidation purpose. That is 1,10,740. Parent share 70%, NCI we calculate. Now, how do we calculate NCI balance? Take the opening balance, add share in post-acquisition, total carrying amount minus dividend paid. Very important adjustment because we have paid the dividend subsequently. If you have paid the dividend subsequently, you have to reduce the dividend, so you get the carrying amount for consolidated balance sheet. Then coming to the other equity, retained earnings of the parent, dividends adjusted, and whatever has come from the subsidiary, you will take it as it is, and this will be the closing balance. This dividend declared 52,416. You can see here. $74,880 into 70%, you get 52,416. That is what is the component of dividend which has been declared. Okay, so this dividend we have reduced it, and because it has been adjusted automatically in the subsidiary or profits, you will get the closing balance, right? Now coming to the consolidated balance sheet, there is no other adjustment you have to do. What you have to do is simply take up land and building, parent, subsidiary plus fair value adjustment. Plant and machinery, parent, fair value that you have calculated as on 31st of March. Inventories, both these inventories plus the fair value adjustment. Trade receivable, same, add it. Cash and cash equivalents, just add it. Trade payables also, this plus this, and fair value adjustment. Once you do that, the remaining part of the balance sheet will be simple and straightforward. Okay. Now, coming to the next one, chain holding has not been frequently tested in the examination, but again very important. Chain holding is where you have a parent and a subsidiary, and the subsidiary has another subsidiary which we call it as sub-subsidiary. So parent has, let us say, 80% in subsidiary and subsidiary has 60% in sub-subsidiary. Now here what you need to understand is there are two subsidiaries for this P. One is S, one is SS. One is S and one is SS. Now if parent has 80% in S, this we know how to consolidate. How do we consolidate this sub-subsidiary? So you have to see what is the effective control. Effective control is 80% of 60%, 80% of 60%, that is only 48%. Sir, but with 48%, how do we get control? See that 48% is for the purpose of consolidation. 48% is for the purpose of consolidation. For the purpose of control, you actually control 60%. So what you have to see is parent has 80% in S and parent has 48% in SS. So in that case, what is the effective structure? 48% is held by the parent out of the 60%. 12% is owned by NCI of S. So the logic that you have to understand here is parent has 80% in S, S has 60% in SS. Out of the 60%, 48% belongs to P and 12% belongs to the NCI of S. So P is holding 48%, NCI of S has 12%, NCI of SS has 40%. So for non-controlling interest, the total will be 40% plus 12%, 52% will be the NCI component. 52% will be the NCI component. That is the first thing. Then, if there is an indirect and direct control, for example, P has 80% in S, S has 75% in SS, and P directly has 10% in SS. In that case, how does it work? Here, P through S has 80% of 75%, that is 60%. P directly has 10%. You add this. So 60 plus 10, 70% becomes the controlling interest. What about non-controlling interest? Out of this 75%, 20% are controlled by NCI of S. So 15% becomes your non-controlling interest, and NCI of SS directly is 15%. So NCI becomes 30%. This calculation is very, very important for you in the examination. Whenever there is a subsidiary and a sub-subsidiary, calculation is very, very important. Okay, between the NCI and the parent. So what you have to take? Parent through subsidiary, parent direct, and NCI of subsidiary, NCI of sub-subsidiary. Okay, so once you do this, remaining calculation is very easy. Only thing, one more thing you have to keep in mind is, for computation of goodwill and capital reserve, investment by subsidiary in sub-subsidiary is considered only to the extent of parent share in subsidiary. What do I mean by that? Investment by subsidiary in sub-subsidiary is considered only to the extent of parent share. So, if subsidiary has invested 100 in sub-subsidiary, 100 rupees, what is the parent stake? Parent stake, let us say, is only 60%. So, you will take only 60 rupees for the calculation of goodwill. Sir, why is that the case? Because 40 we are saying is non-controlling interest. It is owned by non-controlling interest. So, while calculating the non-controlling interest, you will reduce the NCI of pay. While calculating NCI of parent, you will reduce the share of NCI in the investment in sub-subsidiary made by subsidiary. So two things you have to keep in mind. Out of 100 of investment, you will take only 60 for calculation of goodwill, and you will take 40 you will reduce from NCI balance, because that we are saying NCI is holding, or NCI has so much of investment in sub-subsidiary indirectly. For this, there is a question of P, S and SS, which is illustration number 11. You can practice it. Only two adjustments you have to keep in mind. You have to take only parent's controlling stake while or parent share of investment while calculating the investment, and when it comes to NCI, you will reduce the share of NCI of parent in the investment in sub-subsidiary made by subsidiary. So, for example, if it is 100 crores, take only 80 crores while calculating goodwill and 20 crores reduced from NCI. This adjustment, if you forget, your balance sheet will not tally. Okay, so that is one thing which is very, very important, right? Then The next thing is on loss of control of subsidiary. Sometimes you may get a 6 to 8 marks question based on this. So like we have getting control, like we get control on subsidiary, there could be a case where we are losing control on a subsidiary. So when we obtain control on subsidiary, what do? We take all the assets, we take all the liabilities, we show NCI, we show goodwill. When control is lost, what we'll do is, we will eliminate assets of subsidiary, we will eliminate liabilities of the subsidiary, we will eliminate NCI, we will eliminate any relevant goodwill. Okay. If at all some investment is retained, then the fair value of that investment retained will be shown in the balance sheet. So, you will de-recognize all assets including goodwill and liabilities of subsidiaries and carrying amount of NCI in the subsidiaries. You will recognize consideration received, investment retained at fair value and balancing figure as gain or loss. So, the entry will be debit bank or assets received, debit investment received at fair value, debit NCI, you are removing NCI, debit all the liabilities of subsidiary, you are eliminating the liabilities of subsidiary, credit asset of subsidiary, remove the asset, credit goodwill, and balance will be gain on disposal. If it is a loss, you will debit loss on disposal. If at all there is any OCI balance related to the subsidiary, you will classify that to P&L as if you have disposed the underlying asset. For example, if there is a revaluation reserve on PPE, this you will show as OCI. This OCI, when you sell, you transfer to retained earnings, right? So that you will transfer to retained, not P&L, retained earnings. If there is a change in parent ownership interest in a subsidiary that do not result in parent losing control, they are considered to be equity transaction between parent and NCI. So you will debit cash, credit NCI and credit other equity. So basically what does this mean? If, for example, from 70% we brought down to 60%. Now this is not a loss of control. If it is not a loss of control, then will we eliminate, will we remove assets? Will not remove assets. Will we remove liabilities? Will not remove liabilities. Will we remove goodwill? Will not remove goodwill. Then what do? Amount received, you will debit. You will increase the NCI based on the share of NCI in net asset, and any gain or loss will be credited to other equity. Theory concepts you can read it through your own. Now we will take one more question. That is on Ishwar Limited RTP question. Very good question. This is a comprehensive question, a very long question actually. Okay. Very long question. I don't expect such a long question to be asked in the examination, but if you practice this question, then almost all types of questions on consolidation you can handle. Ishwar Limited holds investments in Vinayak Limited. Draft balance sheets are given below. Now here, additional information. On 1st April, they acquired 400 million shares in Vinayak Limited by means of a share exchange of 1 share in Ishwar for every 2 share acquired in Vinayak. The market value of 1 share in Ishwar was 7. So basically what? For every 2 shares, he will give 1 share. So how many shares are here? This is on 31st March. Vinayak Limited, share capital, rupees 1 share. So you have 5 lakh and this amount is in thousands. Okay, so we'll just take 5 lakhs. 5 lakhs divided by 2, you are issuing 2,50,000 shares multiplied by 7 is the fair value. That becomes your purchase consideration. They appointed a professional firm for conducting due diligence for acquisition of Vinayak Limited, cost of which amounted to 15 million. This is not a part of your purchase consideration. They included this acquisition cost in the carrying amount of investment in Vinayak Limited in the draft balance sheet of Ishwar Limited. There has been no change in the carrying amount of this investment on balance sheet since 1st of April. So here what they have done is, this investment incorrectly includes what? It incorrectly includes the 15 million which has been paid as transaction cost. This we have to eliminate. So what happens? You are left with 2,50,000 into 7, that is 17 lakhs 50,000. Okay, so only 17 lakh 50,000 is the investment. This 15 million you will eliminate. Sir, what about balance? Balance could be some other investment. On 1st of April, individual financial statements of Vinayak Limited showed the following balances: retained earnings 750 million, other components of equity 25 million. The director of Ishwar Limited carried out a fair value exercise to measure the identifiable assets and liabilities on 1st of April. Property having a carrying amount of 800 million, land component 350, building component 450, have an estimated fair value of 1000 million, land component 400, building component 600. So why they have given two things? One is it is a fair value adjustment, but they have given two things because land it will not be depreciated, building we have to depreciate. And this is on 1st of April of year 1, and here we are calculating this on 31st March of year 4, which also means year 2, year 3, year 4, there is 3 years depreciation that you have to consider. Plant having carrying value of 600 million had an estimated fair value of 700 million. Useful life was 4 years. None of this plant and equipment had been disposed between 1st April and 31st March. Now 1st April was 600 million and now it's 700 million. That is 100 million of increase in fair value. Depreciation for how many years? Again 3 years. They have life of 4 years. 3 out of 4 years you have to depreciate. On 1st April, notes to financial statement disclosed a contingent liability. On 1st April, the fair value of the contingent liability was measured at 30 million. Contingency was resolved in the year ended 31st March of year 2 and no payments were made by Vinayak Limited in respect of this liability. Now what does this mean? On 1st of April, there is a contingent liability of 30 million. Is it an identifiable net asset? It is an identifiable net asset. Even though we don't recognize contingent liability, the fair value of contingent liability on date of acquisition has to be shown as a liability. Subsequently, on date of consolidation, the value has become 0. So we will reverse that. Fair value adjustments have not been reflected in the financial statement of Vinayak Limited. In the CFS, fair value adjustments will be regarded as temporary differences for the purpose of computing deferred tax. Rate of deferred tax to apply temporary difference is 20%. So 20% deferred tax. Director of Ishwar Limited used proportion of net assets method. Impairment review of goodwill. So this is an additional concept which comes from Ind AS 36 for impairment of assets. No impairment of goodwill on acquisition was evident when the reviews were carried out on 31st March year 2 and 3, but on 31st March of year 4, they carried out a further review and concluded that the recoverable amount of the net assets on that date is 2000 million. Vinayak Limited is regarded as a single CGU for the purpose of measuring impairment. Now here, please understand, they use proportionate net asset method. So whatever goodwill you have, that goodwill is part goodwill, we have to gross it up and make it 100% goodwill. So this is an independent concept coming from Ind AS 36. I don't think they'll make such a complicated question for Ind AS 110 for the examination. For the purpose, on 31st March, Ishwar Limited completed the construction of a non-current asset with an estimated useful life of 20 years. Cost of construction were recognized in PPA and depreciated appropriately. Ishwar Limited has a legal obligation to restore the site work on which non-current asset is located. The estimated cost of this restoration work at 31st March 2043 prices is 125 million. This is not of subsidiary, this is of the parent. Directors of Ishwar Limited have made a provision of 6.25 million, 1/20 into 125 million in the draft balance sheet on 31st March. So this happened on 1st of April of year 3. An appropriate annual discount rate to use in any relevant calculation is 6%, and at this rate the present value of ₹1 payable is 31.2 paise. Prepare this consolidated balance sheet. Now what does this mean? This similar question was given as a case-based MCQ in the recent RTP. Okay. Now here basically what this means is they have made a provision of this 6.25 which is incorrect. You have to make the correct provision and remove the different provision. Now here this part, very unlikely that they will give you as a part of consolidation. Even if they give it to you as a part of consolidation, you can make these adjustments and do the thing. The most important thing here is impairment and deferred tax asset. That is where the calculation becomes very, very complicated. Now we need deferred tax asset or liability on the date of acquisition, on the date of consolidation. Okay, so let us get on to it. Date of acquisition 1st of April, consolidation 31st March. So any adjustment will have 3 years impact on depreciation. Keep this in mind. Okay. Now here, say this. Net assets on date of consolidation, date of acquisition, how much is post acquisition? Share capital 5 lakhs, 5 lakhs. So nothing is post acquisition. Retained earnings 750 on date of acquisition, 1050 on date of consolidation, 3 lakhs is post acquisition. Other component of equity 50, 25, 25 is post acquisition. Land. Now fair value adjustment, this is very important. Fair value adjustment, land 50,000 on date of acquisition, 50,000 on date of consolidation, there is nothing in post acquisition. Building 1,50,000, 1,50,000. Immediately you have to see depreciation for building. How much? 3 out of 30 years. Then plant and equipment 1 lakh, 1 lakh fair value adjustment, depreciation 75,000, 3 out of 4. Fair value of contingent liability, date of acquisition 30,000, date of consolidation 0. Why 0? Because we have settled the liability. Now what will this result in? This will result in post acquisition profits. This will result in post acquisition profits. Deferred tax liability 5442. Now this we have to calculate separately. Okay, so how to calculate separately? I will show it to you. Now here, if you see the fair value assets, or I can just show the calculation. If you see the increase in value of net assets on date of acquisition, and this is on date of consolidation. Okay, how much is date on date of acquisition? 2,70,000. So how did we get this? See, 50,000 plus 1,50,000, 2 lakhs plus 1 lakh, 3 lakhs minus 30,000, 2,70,000. 2,70,000 increase in assets. Increase in assets will result in deferred tax liability. So you will have deferred tax liability of 2,70,000 on 270, 54,000. On date of consolidation, it is 210 only. How? 50 plus 150 minus 15 plus 1 lakh minus 75 minus and 0 here, that results in 2,10,000. So 42,000 is DTL. 54,000 DTL on date of acquisition, 42,000 DTL adjustment on date of consolidation. So this will result in post acquisition earnings. Liability is reduced of 12,000. That is what you can see here. Right? Now out of this total, NCI is 20%, Ishwar is 80%. Okay, so 20% here and 80% here. Now here, because they have given other component of equity, or they have given your other components of equity, that is 25 and 25. This 25 you can split directly, 80% and 20%. So 80% is 20,000 and 20% goes to NCI, and balance out of 221,600, 2,01,600 is retained earnings. Even if you don't do this split, at the most you will lose half a mark, but your final answer will be correct. Okay, so here one adjustment. So now see, if you do it in a structured way like this, what is there on date of consolidation and what is there on date of acquisition, you will save a lot of time. Okay, that is why I say this is a very important question for getting trained in the examination. Now in the previous question what we did date of acquisition separately, date of consolidation separately. That also can be done, not a problem at all. Now goodwill, when it comes to goodwill calculation, fair value of consideration, we have they have directly said that is 2,50,000. Oh, I think I did a mistake here in a hurry. Don't do that mistake in the examination. I have taken full. It has to be 80%. So 2,50,000 into 80%, 2 lakhs multiplied by 7, 14 lakhs. So fair value of consideration is 14 lakhs. Okay, NCI proportionate share in net assets from working note above we can get 1698. Fair value of net assets we have already calculated. This is the goodwill. Impairment, now this is very important. This goodwill is 80%. We have to make it 100% goodwill. So while calculating goodwill, you have to take 100%. Goodwill is grossed up. If you have forgotten, revise the impairment concepts that you have learned in Ind AS 16, Ind AS 36. 259 is the goodwill. Net asset on date of consolidation 1768. How did we get? We got it from here. Okay, so this is the total carrying amount. Recoverable amount is 20. So impairment is 27 lakhs. This is the total impairment. 80% is parent. So parent share is 21,600. 27,000 into 80% is 21,600. Will NCI be here? NCI will not be here because NCI is using we are valuing NCI using proportionate share in net assets method. Then this is an independent adjustment. This is not related to consolidation. That is provision based on your the decommissioning part. So here what they have said is we need provision on 125 million. 125 into present value factor they have given is 31.2. 31.2. So required is 3,900. Provision required is 39,000, sorry, 39,000, right? And interest on provision at 6% is 2340. Depreciation on restoration provision is 1950, because 39,000 divided by 20 years, that is, how 20? It should be 40, no? Just a second. 20 years. So 20 years means this again 20 years. So it should not be 43, it should have been 23. Anyways. So 20 years is 1950. So this is the depreciation part. This depreciation we should have provided, and this interest we should have provided. So how much should be provided? 2340 of interest plus 1950 of depreciation. We should have provided 4290. We have recognized 6250. So 1960 has to be reversed. 1960 has to be reversed. How will we reverse that? We will reduce it from the, we'll add it to the P&L. Okay. And how much should we add it to PPE? 39,000 plus, sorry, minus 39,000 minus 1950. 37050, we have to add it to PPE. That is 39,000 and depreciation, net of depreciation. We have to credit to P&L 1960 and a liability of 35090. That is opening liability 39,000 opening liability 39,000 plus interest 2340 41340 minus what they have provided 6250. So 35090 will add it to liability. Here the thing that you have to understand is they have already created a liability of 6250. They have already created a liability of 6250. For the balance you have to create the liability. Okay. So this is a separate adjustment. I don't expect it to be added to Ind AS 110 question. NCA balance, opening balance and post acquisition share. Consolidated reserves, retained earnings as per the balance sheet of issuer. Then acquisition cost you have to reduce because it cannot be debited to P&L. Then decommissioning provision rectification 1960 from the above working note. Goodwill impairment from the previous working note. Share of Vinayak, so much, total is 3031960. Then other component of equity, balance as per balance sheet and post acquisition share. Okay, a lot of times what you can also do is have a single line item saying other components of share of post acquisition. If you don't split also it is okay, but if you split it is better. Then you can prepare the consolidated balance sheet of issuer and Vinayak. Adjustments to be made in PPE. Investment we have to reduce 14 and 15. 14 lakhs is your purchase consideration, and 15, the 15,000 that you are removing, that 15,000 is your transaction cost. Okay, goodwill will be calculated after impairment and other adjustments. Then deferred tax as per the balance sheet plus final consolidated number. Okay, so this is given in RTP. I don't think a 20-mark question like this, such a lengthy question, will be tested in the examination, but for calculation purpose it becomes very easy for your examination. Then what you can do is I'll be releasing a video, a detailed video on these two questions. This is Nov'23, 20 marks. This was a bouncer question. If at all you get a bouncer question in the examination, don't worry, do it towards the end. With whatever assumptions you can make. I have explained how to handle this question and this question. This is from May 24 examination. These two questions you can have a look at it. Pretty good question, which will help you. Okay, so this is the overall, just a quick revision of Ind AS 110. Theory concepts you can read it on your own, and there should not be any doubt in theory question. Only thing you have to keep in mind is how to carry out those specific adjustments. Okay, then one more thing, in the recent CA Inter examination, they have not asked a full-fledged balance sheet. They have asked the students to compute 7 items of the balance sheet. 7 into 2, 14 marks. Okay, that kind of question can also be expected in the examination. I hope you found this revision session useful, and I'll be uploading soon revision notes on financial instruments, and also followed by a revision video. Thanks a lot for joining in, and hope this video was useful.